Hello everyone, my name is Mark Newman. I get a lot of questions from people who are looking to subdivide a property and build a new house on the subdivided land, either to rent or to sell, and they want to know what are the taxation implications. And I want to take you through that today. Firstly, what happens for a rental? So let's say we've subdivided the land, we build a new house on it, and we want to rent that out. So what are there any capital gains tax implications? The answer is, until we sell it, no. So whilst it's a rental property, what we need to do is obviously keep records of our rental income and our associated expenses, i.e. council, interest on the development loan, and other costs for the rental property, and they'll need to be included in our taxation return. Also, as it's a new property, we will be able to claim depreciation on the building costs, and I would encourage people to go to somewhere like BMT, get a depreciation report so that we can claim those costs on an ongoing basis. What the taxation point for capital gains tax is actually when we sell it, and how do we work that out? So going back through the previous videos, what we need to do is firstly look at the land. So obviously we go back to when the land was first bought and allocate the cost for the portion of the subdivided land. So let's say in this case that's $200,000. We then add the building cost, and let's say that's $300,000. So now we have a cost base for the property for tax purposes of $500,000. But remember, if we've been claiming depreciation, we have to reduce that value. So let's say the depreciation is $100,000 on the property. We've now got a cost base of $400,000. So if we sell it for more than $400,000, that's going to be a capital gain. Obviously, if we've owned the property for more than 12 months, we'll be able to halve the capital gain, but that will still need to be included in our tax return, and that will be taxed at our marginal rates of tax. The other option is we build and sell straight away. So we've got an intention of making a profit. So for this purposes, because we've got an intention of making a profit, there's two things we need to be aware of. Firstly, we've gone for the subdivision, we've gone beyond mere realisation. That is doing the minimum for the subdivision. So if we go beyond the minimum, the ATO now treats this as an income generating thing, and we're intending to do it as a profit. Therefore, any profit that we make gets included in our taxation return. So that's 100% profit gets included in our tax return, and it gets taxed at our marginal rate. We don't get the 50% discount. So we have the income tax. And the other thing we also need to be aware of is GST. If our turnover is more than $75,000, we need to register for GST. Now that means if we sell the land and the house for more than $75,000, we have to register for GST. So GST will be remittable on the sales price. We'll also get to claim back GST on the development costs, and we can also take into account the margin scheme, which I'll do another video on, to help reduce the amount GST that's going to be payable to the ATO. So how do we know which one we fall under? The ATO's got a basic rule of thumb called the 5-year rule. If we sell the property within 5 years, their view is we've done this to make a profit, therefore it will be assessed under income tax and GST will be applicable. If we hold it for more than 5 years, then we can go down the capital gains tax path and only claim 50% and only pay tax on 50% of the profits. Now, the ATO does look at what our original intention is. So for example, if you develop this property to rent it out, but due to financial difficulties had to sell it, then we can actually go to the ATO, ask for a ruling, and they'll come back typically and say that we can go down the capital gains tax path. But remember, that's a once-off thing. If we keep going back to the ATO, they'll look at us and just say, hey, you're a developer, and therefore put us down the income taxation path. I hope this clarifies two scenarios. What happens if A, we're going to be renting it out and eventually sell it long term, or secondly, we go in there to develop it to make a profit and then to sell it, and the taxation implications. If you have any questions, please do not hesitate to ask. Thank you for listening. Mark Newman.